Good morning, everybody. Welcome to my weekly webinar update. Appreciate you all being here. As always, any questions that you have, please post them onto the chat. I'll happily answer those as I continue to try to give new information every single week. A lot of what you'll hear today will be a recap or a redo of what we covered on Monday with a little bit of new information, but every week I come up with new content. I try hard not to repeat what I had covered in previous weeks. So if there's anything that you want to review, you can see all of my prior videos by going to youtube.com/JohnLoneKing, and you can watch all of that stuff there. All right, so let's go ahead and get started with today's presentation. So today we're going to talk about a lot of things. We're going to cover from a different angle. We're going to talk about the forbearance impact on the mortgage market. It is the single biggest challenge that the mortgage industry is facing right now, and it is getting worse by the day. And there's a lot of consequences to this. I've touched on it a little bit on previous weeks, but I'm going to dive in really deep today and talk about that. We're going to talk about forbearance options for consumers and share some information there. I'm going to pull out my crystal ball and I'm going to talk about the future of interest rates and the future of housing prices. And then we're going to put the crystal ball away and we're going to pull out the DeLorean and hop in the time machine. And we're going to do a time machine exercise and that'll be fun. Then I'm going to talk about jumbo alternatives because we've got a market that has almost completely collapsed. Significant challenges in the jumbo market. And then if Jeff is able to join us today, he'll provide any updates we've got on the title and escrow world, specifically with e-signing and e-recording and that kind of stuff. And then I'll do a plug on my upcoming webinars, and then we'll move on. Great news was Monday's webinar ended about 15 minutes early, so it was only 45 minutes. Let's see whether I am longer winded today or not. All right. So an update on the forbearance numbers. First and foremost, the numbers are moving in the right direction. What I mean by right direction is that, as you will see, and I'm pulling out my little handy dandy spotlight tool. So we've talked already in prior weeks about the tidal wave or tsunami of forbearance requests. All mortgages started out at less than a quarter, basically a quarter of 1% of all mortgage holders were in forbearance as of March 2nd. I do want to take a quick minute to define, because I actually got a really cool, I read an article that made it super, super simple to understand what is the difference between deferment and forbearance, because a lot of people they use those words interchangeably. And so just so that you understand, deferment means you don't owe any payment and no interest is accruing. Forbearance means you don't have to make a payment, but interest does accrue. And that's an important distinction because there's a lot of people right now that are having significant financial struggles, and they're dealing with their credit card company, their car loan company, all of their creditors. And so understanding the difference between those words, if you can get a deferment, that's best. Now, there's no deferments in the mortgage world, but just in general, if you can get a creditor to give a deferment, that means you don't make a payment and the interest is not charged. If you are offered a forbearance, it means you don't make a payment, but interest is charged or interest does accrue. So just kind of an interesting side note for educating you and your clients. So we went from a quarter of a percent to a month later, literally, 10 times that. And we had 2.75% of all mortgage holders in forbearance. April 5th became 3.75. We're up to 6% on April 12th, and we've only had a minor increase in the week after that, up to April 19th. I think we are going to see the tidal wave continue to swell right up until tomorrow, because people are, how shall I say, procrastinators. That's the right word. And they're going to wait until the moment that they have to file for forbearance before they do it. And so we're going to see a large percentage of people, and I hope that doesn't happen, but I fear that's going to happen. So we're going to see these numbers jump up. I think we're going to easily see over 10% of all mortgage holders in forbearance before the end of April. More importantly is the challenge with FHA and VA. FHA and VA, the credit quality is coming under, it always has been a concern. Now, the good news is that Ginnie Mae backs those and guarantees them for banks. And so we've got an insurance policy that will recover the costs for the bank. But in the meantime, when somebody goes into forbearance, there's a huge cost to the servicer. And I'll talk to you a little bit about what this is going to look like, because we've gotten more news and more information about it. But the bottom line is, this is the reason why you've seen the credit score minimums go up significantly for FHA loans. It's the reason why, part of the reason why we've seen down payment assistance loans go away, and the banks are unwilling to do them, because your FHA and your VA buyers definitely don't have as much money in savings compared to your typical conventional borrower, and that is showing in the fact that there's significantly greater numbers in forbearance for FHA and VA loans. So it'll be what it'll be as we move forward, but that's just kind of a quick update on the numbers. Now I want to give you an update, and really I want to dive in deep to help you guys understand the dynamics of what's happening behind the scenes. I really think as you're talking to your borrowers, and more importantly, as you're talking to other people in the industry, and I know that a lot of you are focusing on, hey, where do I go after getting business? I can't get open houses right now, so I can't find buyers for open houses. I've always been a proponent of going after business people in the community. And if you can be a resource to help educate those business people, or at least have a highly intelligent conversation about how all of this works, that's going to help elevate your perception in their eyes and give them a greater likelihood of referring people to you. So this is some great, fodder for conversation with business people as well as borrowers alike. Mark Calabria is the head of the FHFA. So he was appointed he was appointed by Trump and was confirmed in 2018 to run the FHFA. The FHFA is the division of the federal government that oversees Fannie Mae and Freddie Mac. So it's called the Federal Housing Finance Administration. They oversee Fannie Mae and Freddie Mac. Mark Calabria feels and has always felt like the government should be hands-off on the housing market. And he did not think the government should be that involved in the housing market. As a matter of fact, he isn't even a fan of 30-year fixed rate mortgages, which, if you guys aren't aware, the 30-year fixed rate mortgage is really an American thing. If you go into Europe or most other countries, your buyers of homes are not getting 30-year fixed rate mortgages. They're getting adjustable rate mortgages. The United States came up with a 30-year fixed rate mortgage to protect the consumer, give them more stability, but it is a double-edged sword. And I won't go too deep into it, but the bottom line is he feels that strongly about it, that he feels like, hey, the government shouldn't be pushing 30-year fixed mortgages. We should let the banks do what's best for the banks and let the private market sort it out. And that means that the private market doesn't want 30-year fixed mortgages. The banking industry doesn't want that. And now they're happy to comply, but that's not really a good thing on the bank's side. Now, during Calabria's confirmation hearing, he backed away from that and said, no, I'm not going to worry about getting rid of the 30-year fixed mortgage. But it's giving you some insight into who this guy is and what he thinks. And so what he has done is basically last week on Tuesday, he announced, and I told this to you guys last Wednesday, he announced that lenders were only on the hook for the first 4 payments during the forbearance period. Now, when I mentioned that on Wednesday morning, I thought, guys, this is good news. He's at least set a limit and told us how many payments we have to make. Because as a reminder, when the borrower stops making payments in forbearance, the lender is now on the hook. The servicer is on the hook to still write the check every month to the investor and to still write the check for the property taxes and the homeowner's insurance and flood insurance if there is any. So the servicing bank is going to be out a significant amount of money, and it's creating a major concern about liquidity and the ability for banks to survive, for mortgage banks to survive in the environment that we are in. So what he did is said, okay, you have 4 months that you're going to make payments, and that's it. Well, that sounded really, really good. And the reason he came up with 4 months is because the old rule historically on forbearance has been that a bank is only responsible for 4 months. And in the 4th month after forbearance starts, the loan is considered in default. And as soon as a loan goes into default, Fannie Mae or Freddie Mac immediately write a check to reimburse the lender. The problem is the CARES Act says these loans are not in default. So at the end of 4 months, when we're no longer on the hook for the money, that's great, except it's not in default, and Fannie Mae and Freddie Mac are not writing us a check to reimburse the bank who has covered those 4 months. It's a good thing that at least we know we only have to cover 4 months, but it's a bad thing because we have absolutely no clue when we're going to be able to collect that money back. Someday we will, but the truth is it could be when that mortgage pays off. Again, typical mortgage through refinancing or selling pays off in about 5 years, but we could be out 5 years before we get those 4 months of payments back. You multiply that by 10% of the servicing portfolio at a minimum, that's a significant amount of money. that no mortgage bank has that much money, and we don't have access to capital like the big banks do. We can't go to the Federal Reserve and borrow money, which is exactly what the CARES Act called for. And Calabria decided, no, I think that's a bad idea to give the banks, the mortgage banks, access to a line of credit to solve this problem. We're going to let them deal with it on their own. And his solution was simple. He said, I don't care if a mortgage bank fails, we'll just transfer the servicing to another bank. It'll be no big deal. But it's not as simple as what he said, because if you were a bank, would you want to take over the servicing of a company that crumbled because too many of their borrowers were in forbearance? You're basically taking on a problem. Calabria is setting us up for some major hurdles in the mortgage market, and it's going to impact you guys and your buyers. And it's why I'm spending more time talking about it today than I have been in the past. So last week on Wednesday, another announcement came out, and Calabria said, okay, here's the deal. I told you guys yesterday that you're only on the hook for 4 months of payments, but I know everybody's freaking out because there's a rule with Fannie Mae and Freddie Mac that says if somebody funds a mortgage and goes into forbearance before Fannie Mae and Freddie Mac buy the loan from the lender, Fannie and Freddie won't buy the loan. So I'm going to repeat that. If somebody takes out a mortgage on April 1st, depending upon the process, it can take from 2 to 8 weeks for a bank to get that loan sold to Fannie Mae or Freddie Mac. If within that 2 to 8 weeks after the loan funds, the borrower loses their job, we as the bank must accept their forbearance. We cannot ask for proof. So if they just call and say, hey, I want a forbearance, we have to give it to them. Yet once we give it to them, we're now not allowed to sell the loan to Fannie Mae or Freddie Mac because it's now damaged goods. And Fannie Mae and Freddie Mac have always had that rule. So he comes out and he says, hey, no problem. I've solved your problem. I'm going to buy loans that go into forbearance. And I think I mentioned this on last Wednesday's call, that we had great news. They're going to buy loans that went into forbearance even before the loan was sold to Fannie Mae or Freddie Mac. But what I missed in the fine print quickly before I did this presentation last week was the fee that they're charging. They have put it on the backs of the mortgage companies to say, oh, by the way, if you underwrote the loan and double checked their income and triple verified that they still have a job by the time that you fund the loan, which by the way is making us not just triple verify, but now we're going to verify 10 times before we close the loan to make sure there's no chance that there's been any reduction in income. But if after that they go into forbearance, they said, no problem, we'll buy the loan. But we're going to add on a 5% fee to the loan amount. So if it was a $300,000 mortgage, we're going to charge the mortgage bank $15,000 because that homeowner went into forbearance between the day we funded the loan and the day that we sold the loan to Fannie Mae. Now the good news is that's cheaper than what it would cost us if we couldn't sell to Fannie Mae. We might take a 10, 15, 20, 25% haircut. So Fannie Mae thinks they're doing us a favor by buying these loans and only giving us a 5% reduction in our revenue. Guys, we don't make 5% on these loans. So we're losing a significant amount of money if we sold a loan that somebody went into forbearance between the time we closed it and the time that we sold it. But it gets worse because that 5% fee is only if it was a first-time home buyer. If it's a non-first-time home buyer, which is every refinance and any purchase where somebody's owned a home anytime in the last 3 years, now the fee becomes a 7% fee. That means it's costing us $21,000 out of our income to sell that loan simply because the borrower decided to go into forbearance. And it's one thing if we at least could prove that they lost their job, but we can't ask the buyer or borrower for proof of why they need a forbearance. We have to grant it for them, and then we immediately lose 7% of the loan value in a penalty fee. That puts the banks in a super defensive position, and it's creating some serious ripple effects. The other thing Calabria said is, oh, by the way, we're not going to buy any cash out refinances, which makes absolutely no sense. He's basically said if somebody does a cash out refinance and they go into forbearance, we're not going to buy it. You guys now have to sell it somewhere else and lose 10, 15, 20, 25% of the value of the loan. which is now exacerbated the concern about cash out refinances. Now, I know I'm talking to a group of realtors, and so for you guys, cash out refinances aren't as important, but there are situations where you're talking to a past client and they need that money in order to pay bills, consolidate, renovate the home, fix it up so they can sell it down the road, or maybe they're pulling cash out in order to keep that current home as an investment property and buy their next property. Or they're pulling cash out in order to buy an investment property. Maybe they're keeping their current home and they just want to invest in real estate, but they are going to be severely hampered, and the pain is only barely starting to show. So there's been a lot of rumors flying around. I don't try and talk to you guys about rumors. I only try and talk to you about fact. What I'll tell you is every lender, including Summit Funding, in the last 7 days has made the fee on cash out refinances more expensive than they were previously. The amount we made the fee more expensive varies by lender, but the pain is already being felt. There are 2 lenders, I won't name names, but there are 2 lenders who have made a decision unilaterally. They are no longer doing cash out refinances for the time being. And the biggest fear is the warehouse, actually, I guess I did name names because it's at the bottom of the slide. Anyway, the biggest fear is the warehouse lenders. I've talked to you guys about this over the last couple of weeks. The warehouse banks hold such an integral role in the mortgage financing ecosystem because mortgage banks don't have enough money to write checks to fund all of our mortgages. We borrow the money from a lender using a warehouse line of credit. That warehouse line of credit has their own criteria of what they will accept in credit quality for the borrower. And the problem is one major, I said it down below, Chase, has said they will no longer be a warehouse lender for any cash out refinances. And when one company says no to something and a couple more start saying no, then everybody else says, wait a second, I don't want to have any adverse selection. I don't want to be the last person holding the bag that funds all the cash out refinances. And now they end up that they go into forbearance and a bank can't sell them. Because remember, if the bank has to sell a mortgage at a loss, they have to write a check to cover the difference. Because that $300,000 mortgage, we borrowed that money from the warehouse bank. If we sell that mortgage to Fannie Mae for a 5% loss, well then Fannie Mae's only reimbursing us $285,000. Where does the other $15,000 come from to pay off the warehouse line of credit? It comes from my company's checkbook, and we have to have the funds to write that check. If we don't have the funds to write that check, that is the reason you will see mortgage banks fail in the next couple of months, because they can't afford to pay back the warehouse line of credit. And if you can't pay back the warehouse line of credit, just like if you can't pay your Amex card, they're cutting off your credit limit. You can't borrow any more money if you can't write a check to make the payments that you borrowed from before. That is the challenge, because those warehouse lines of credit are stuck holding the bag. If we can't cover that $15,000 loss, then we can't pay them off. They now own that $300,000 mortgage that they have to turn around and sell for a loss. And the warehouse line of credit does not want to be stuck with that. So we are having a severe challenge right now that I fear is going to get worse when it comes to cash out refinances. Right now, it's a small impact, but I'm hearing a lot of rumors that impact's going to get bigger. Maybe we're going to require a significant amount of reserves. Maybe the loan to value is going to be cut significantly. Maybe the rates and fees are going to go up. There's a lot of things I've been hearing, but just be aware that there is likely to be significantly more changes to cash out refinances, because the federal government simply says if a borrower goes into forbearance on a cash out refinance before we sell it to them, they won't buy it. And that's a huge risk to the mortgage bank. Now, this last bullet point here about investment properties, I still haven't been able to get full clarification on it. I've heard some rumors, enough rumors that there seems to be some credibility that Fannie Mae and Freddie Mac are also, in some cases, not backing investment property loans under certain circumstances. When somebody goes into forbearance, they're not buying those either. I've seen, now Summit's made no changes yet to our investment properties, the guidelines or the rates, but I've already seen some banks make some very significant changes to what their guidelines are and what their interest rates are on investment property loans. So that one I don't know as a fact of where it's coming from. I believe it's coming from Fannie and Freddie, but I do know that there are banks that are already significantly trimming their guidelines on investment properties, so please be aware of that. And as I mentioned earlier, Wells Fargo and Chase both announced significant limitations on cash out refinances. It may just be with the big banks, but be aware that the big banks also are the conduit for the small mortgage companies, because small mortgage companies can't service their own loans. They have to sell the servicing to the big banks, and if the big banks won't do it, that means the small mortgage companies can't either. It's only those mid-sized mortgage companies like Summit Funding that are going to be able to pick up the slack here. All right, questions about forbearance update from the mortgage side of the world and the impact of that, put it into the chat. Otherwise, I'm going to move on and I'm going to talk more about the borrower's side of forbearance. We've talked about this a lot, guys. I want to give some real good clarity here because D-Day is tomorrow. D-Day is tomorrow for all of your borrowers that are, one second. Oops, that's not what I wanted to do. Perfect. All right, so D-Day is tomorrow for all of borrowers who have asked for a forbearance on purpose or accidentally, and their payment has not been made for April. I have a client I talked to on Monday night. So for those of you who were on the Monday call, this is some new information that I didn't even realize was happening. So I had a client I talked to about a refinance, and he says, you know, John, I want to refinance my primary home, et cetera, and I've got a, you know, we went through the whole thing, talked about his refinance, and then he said, oh, by the way, I have a question about my rental property. And I said, sure. And he goes, I wanted to know about what are the implications of forbearance. And I explained to him the implications are if you filed forbearance on your rental property, I won't be able to refinance your primary home. So if you do that, you're going to have a problem with this refinance. And, you know, I was basically taking him from having 20 years left on his mortgage to 15 years left for exactly the same monthly payment. So it's going to save him thousands of dollars in mortgage, and he makes a good income. So he's not not needing any reduction in mortgage payment. And so I said, there's no, you know, don't file forbearance. And he goes, well, the problem is my tenant told me that he's likely not going to make the May 1st payment. He paid on April 1st, but he's likely to not make the May 1st payment. And so I figured, you know, I might as well take advantage of forbearance since I'm not going to be receiving the rental income from that property potentially. And I explained to him that, you know, here's why I think it's a bad idea, but it's entirely up to you. And he goes, well, John, I understand, but I guess it's a little more complicated. Because a couple weeks ago, I was on the bank's website and I clicked the button to get more information about forbearance. Now, you guys remember the story I shared a week or two ago about another client who clicked the button about forbearance, just wanting to get information about it. But here's where the new part comes in that I haven't heard yet. He goes, so I never heard anything back from the bank, but when I sent them my mortgage payments, they rejected it. And I said, what do you mean? And he goes, they didn't cash the check. They didn't pull the funds out. The money's still sitting in my bank account. They rejected my mortgage payment. And when I reached out to them to ask them why they rejected the payment, they said because I had filed for forbearance. And I thought, oh, okay, well then cool. And he let it go. Now he wants to do his refinance. And so he was supposed to call last night or Monday night and tell the bank, hey, process that payment, please, and remove me from forbearance status. Here's the problem. Once you haven't made the April payment in April, you are stuck, because if you remove the forbearance status, now you're 30 days late. I can't do a mortgage for you if you missed your mortgage payment by 30 days. But if you are in forbearance status, I also can't do a mortgage for you because you're in forbearance. Tomorrow is the last day for anybody to make their April payment, even if they're in forbearance, and still be considered current. But more importantly is I have to make sure the bank processes the payment, because I was unaware that the bank was putting a hold on payments you sent in saying, well, no, you filed forbearance. I refuse to accept your money. That adds a whole new wrinkle here. Now I'm going to repeat what I've said in the past, which is I'm not telling people don't file for forbearance. If you need to, you need to. But this is yet another example of a client that didn't need to file forbearance, Now, if you think about his investment property, sure, it makes sense that he's not receiving the investment income, and so a forbearance makes sense, but he makes more than enough money overall to cover that shortage, but he didn't think there was any negative repercussions. Once he found out, luckily we still had time to solve the problem. Luckily, he still had time to make sure that payment was processed, but after tomorrow, that opportunity goes away. I posted a video yesterday morning on Facebook. It's had, I don't know, 100 views in the last 24 hours, so it got pretty good traction on it. If you haven't seen it, go to my Facebook page, my personal page, and share it, because it basically is, it's about 20 minutes of me explaining all of the ins and outs about forbearance and what somebody needs to know, and imploring them, if you don't want these consequences, you only have until April 30th to make a payment. The final thing I'll tell you about all of that is the client can still choose to go into forbearance in May. So if they're unsure about what they want to do, or if they really want to take advantage of forbearance or not, there's no mandate that said you had to do it in April. If you make the April payment and now you decide by May 30th that you want to go into forbearance, that's a decision you can make at that time. But as soon as you haven't made the April payment and you're in forbearance and we go into May, we're stuck. And we are unsure how long it's going to take for you to be able to refinance. But as I've said a couple of times, my gut right now, and from all the tea leaves I'm reading, says that you can't refinance or buy a home until a year of on-time mortgage payments, which means you have to catch up the forbearance or get into a payment plan and make 12 payments. So we're at least a year to a year and a quarter away for these people to be able to qualify for a purchase or a refinance. And they literally have 24 hours left to make that decision on whether they want that to be a consequence. So time is short, and whatever I can do to help you, or whatever you can do to help me to get that word out, I would super appreciate it. Here's the other piece that is good news about forbearance. Fannie Mae and Freddie Mac have made it super, super clear over the last week, under no circumstances will anybody be required to pay all 4 payments at one time. Under no, and when I say 4 payments, that's if you took a 3-month forbearance, so you skipped April, May, and June. On July 1st, you owe the July payment plus the April, May, and June that you had skipped. There's been a lot of concern about whether that was going to be the case, and so Fannie and Freddie came out very clearly and said, under no circumstances will anybody be required to make a balloon payment. But read between the lines. They didn't say they'll never be asked to make a balloon payment. They just won't be required. You won't be foreclosed upon if you don't make the balloon payment, but it is the best way to maintain your credit rating. Because the CARES Act simply said we will give you 3 to 12 months of forbearance, and it will not impact your credit if you do that. Only way you maintain that lack of credit impact, don't forget, it still impacts your ability to borrow on a mortgage, but it won't hurt your credit score. The only way you maintain that is if you make a balloon payment and catch everything up. Because if you don't make that balloon payment, then the mortgage company will have to modify your loan to spread that forbearance balance over a number of years, potentially put it at the end of the mortgage. A lot of alternatives the mortgage company is going to work through. But to preserve your credit scores, it looks like you're going to have to make that balloon payment. But Fannie and Freddie are being clear, you're not going to be required to, you're not going to be foreclosed upon. But this is super, super important for people to understand. And again, we're up against the time clock because tomorrow is the last day for somebody to make their April payment on time. I covered modification last time, so I just want to use that as a reminder of what happens if you are in forbearance and you can't catch up the payments. They'll do a modification. So clearly, we need to remind our clients to only use forbearance if it's their only other choice. All right, if you guys have any questions about anything else, feel free to post them into chat. Otherwise, I'm going to continue on with the rest of the presentation. All right, so come on, presentation. Here you go. All right, crystal ball. You ready for my crystal ball? The future of mortgage rates. Guys, in a recession, mortgage rates have always stayed low. It's the best tool that the federal government has to stimulate the economy and pull us out of a recession as quickly as they can. Also, rising federal debt also drives interest rates down. all of those checks that we've been receiving, whether it's a stimulus check or an unemployment check or the PPP, the mystery PPP money that really doesn't exist, all of that money is coming from somewhere. And that somewhere is from the pockets of the federal government, and that is our money. And this is not a political statement, it's just a fiscal statement. The money is coming from somewhere, and as the federal debt load goes up, that also drives interest rates down. We are going to see interest rates stay low for at least the rest of this year, and there's a very good chance we're going to see it for a year or two beyond that. It's going to depend partially on the recovery, but we're actually seeing some actions this morning, so a little bit of new information today as well. There's activity in the 3% mortgage coupon. Now I'm going to give you a bit of a broad overview to give you some information on what that means. When we sell mortgages, we sell them into a coupon. And if you know anything about the bond market, the coupon is the rate of return that bond pays. And currently, the lowest, and I should have said 2% coupon. We're trading in the 2% coupon right now. Currently, the lowest coupon that has been trading is the 2.5% coupon. So that means Wall Street is earning 2.5% interest on all of the loans that are put into those pools. The bank still has to make some profit on that. There has to be some money left over for servicing. And so the truth is a 2.5% coupon is really ideal for mortgage rates to the consumer of between 2.9 and 3.5%. If you want to see an interest rate lower than 2.9%, that really needs to be bundled into a 2% coupon. The problem is the 2% coupon wasn't trading. No investors were buying it. That's changed over the last couple of days. That has opened the door. Now, it doesn't mean that the market's going to run through the door, but it's opened the door that if that coupon becomes highly active, we could see interest rates drop by another 0.5% just like that. In other words, interest rates can't drop any further if that coupon does not become actively traded. I know it's kind of an esoteric concept here for some people. My whole point is that the opportunity for rates to go down by another 0.5% just became a seriously real opportunity. So that's a thing you have to be careful with because there's always going to be a cost to it, and there's also a cost for waiting. We don't want to convince our consumers, hey, don't buy a house because rates may go down a little bit more, because prices could absolutely go up. And I'll talk about housing prices in a couple of minutes, and you'll lose the opportunity to buy the home that you're looking for. At the same time, we also don't want to tell our clients, hey, don't refinance yet, rates are going to go lower, because we're also seeing mortgage guidelines getting tighter and tighter and tighter. And so if you lose the opportunity to refinance at 3% because you're hoping for 2.5%, it may get to 2.5%, but you no longer qualify. It's a double-edged sword that you've got to be really careful about. But when I'm answering the question and pulling out the crystal ball about the future of interest rates, I have every expectation rates are going to stay the same as they are now or lower overall over the next year. But we're going to continue to see a high amount of volatility. So be aware when people are buying homes, they have a short amount of time to lock in that rate. If you can give them a longer escrow period, maybe we can have a little more flexibility to wait and lock the rate, because we are going to see some spikes up and down. But big picture, rates are going to stay low unless something crazy happens, okay? All right, so that's the future of interest rates. The next thing I want to talk about is the future of housing prices. But before I cover the future of housing prices, I want to take a minute and do my time machine exercise. So everybody hop into your DeLorean. I'm going to force participation. So I need everybody to put in the chat. So here's the rules, and it's really, really simple. Knowing everything you know today, if you could go back to 2008, and what I'm describing is the tip top of the market where prices were at their peak. Maybe that was 2007, whatever year that was. Pretend you had the choice of buying a house at the absolute top of the market that was your primary residence. You had a 30-year fixed rate mortgage on there. Or you could say, I'm not buying because I know that values are going to go down. I'm going to stay as a renter, and you stay as a renter until today. Would you go back in time and buy a primary home, or would you be a renter? So I need you to post buy or rent in the chat for me. Y'all leaving, everybody saying bye-bye, bye-bye, bye-bye. All right, nobody's gonna challenge me by saying they're gonna be a renter? All right, good. So guys, what I wanna be clear is first and foremost is I did this same exercise last week when I did a presentation to about 25 homeowners. And I asked them the exact same question and I got about a 50-50 response. I got 50% of the people that said I would buy and I got 50% of the people that said I would rent. I don't need to convince you guys of the reasons. I'll explain to you in a second just so that you have this fodder that you can use to talk to consumers. But understand that consumers do not see the market and the opportunity the same way you do. And it's proven to me over and over again in the last week when I've done this to consumers versus realtors, 100% of the realtors say buy, and 50% of the consumers say buy, and 50 say rent. So what you need to talk to them about is, what are housing prices then versus now? Because if you're staying in a house long enough, and I don't know how long each cycle is going to last, nobody knows. But if you stay in there long enough, housing prices do always come back. Now, prior performance does not predict future expectations or whatever the heck the attorneys say I'm supposed to say at that time. But the fact is, housing prices absolutely came back. Average rents have gone up significantly in the meantime. So anybody who was a tenant had the issue of rents continuing to skyrocket. On top of that, let's pretend that housing prices just, they went down and they came up, but they still never got back to where you were. The fact is you still have amortization, the pay down of your balance every single month that you've been paying down and gaining equity, not just because of appreciation, but simply because of the forced savings account, not to mention the tax deduction that you get for being a homeowner. And the final thing that we all know is the stability, because when we went through the last cycle, we had a significant number of people who were evicted from their home because their landlord lost their home. And that instability would have been avoided had they bought a home in 2008. Now, this doesn't tell you what the future of housing prices are, and I'll cover that in just a second. But what I want to tell you is when people ask you the question, hey, where are housing prices going? They really don't care. What they're really asking is this question: is now the right time to buy? And so you need to be able to answer that question not with, well, I think they're going to go up and here's what John King said. You need to answer that question with, here's what I'll tell you in a second what I think is going to happen with housing prices. But if you're asking about whether it's a good time to buy or not, let me explain why I think it's a great time to buy no matter what happens with housing prices. It's called the QBQ, the question behind the question. When somebody asks you a question, you have to figure out, is that really what they're getting at or not? And when most consumers ask you, hey, what do you think is going to happen with the housing market? They're really asking you, is this a good time to buy? Is this a good time to sell? You need to answer the question, but you got to make sure you're answering the question behind the question so that you are getting them to the place that they need to be. So now let's cover what is going to happen with housing. They don't talk to me. Just like this, you guys aren't talking to me, you're just listening. So I listen to a lot of people that are way smarter than I am. There's only like 4 of them in the world, but I listen to all of them, and they unanimously are saying, we think the housing market will continue to appreciate until 2025 to 2026. Unanimously, the people that I talk to have said that. Now, there's some debate over what 2020 is going to look like. Some people are saying that 2020 will have a small amount of appreciation. Some people are saying 2020 is going to be a down year. So the question is, how quickly do we recover from the shelter in place and from the economic issues that we're dealing with? I don't know. I'm not going to try and guess. That's a hard one to peg. Clearly, nobody can know for sure what's going to happen with housing prices long term. But all of the indicators show housing prices continuing to go up. And the key factor that I keep hearing over and over again is the demographics of your late 20s and early 30s people who are moving out of their parents' basement, right? Because over the last 5 to 10 years, you had the boomerang generation that they went off to college, they came back from college and decided to go home and hang out in mom and dad's basement. Why buy a house? Who cares? Guess what? That generation is now at the point where they're ready to get married, they're having kids, and they're deciding, hey, maybe buying a house is a good idea. That is a huge push in demand for housing. That is the biggest component that is going to continue to drive housing prices over the next 5 years, simply because you have a huge segment of the population that's been sitting on the sidelines that are now ripe for wanting to buy homes. If you have the secret sauce to market to that demographic, you're going to make a killing. So if you're thinking about your marketing plans, absolutely include that demographic of 25 to 35-year-olds. Try and figure out who's getting married, who's having babies. Any way you can find that stuff out. Get in good with the local jewelry store. Because the local jewelry store, they're buying the engagement rings, they're buying the push gifts. Hey, you're having a baby, you got to buy something for your wife because she delivered the baby and all you did was stand there and hold her hand. So that's the thing, right? So find out a way to determine who is going to get married, who is having a baby, because that demographic is what is going to be the biggest driver of the housing market going forward. We are going to continue to see housing appreciation, and it is going to come from that demographic as the biggest push to housing. All right, any questions on anything before I move on to jumbo alternatives? No, all righty then. So I want to do a quick recap, guys. The jumbo loans are anything over conforming limits. So every year, Fannie Mae and Freddie Mac come up with their limits, and they come up with two limits. They come up with the national limit, which is currently $510,400. They publish that typically between Thanksgiving and December 10th, and it is effective on January 1st, although they often let us actually close loans before that. So really, it's effective in December. That limit applies to the entire country, except in high-cost markets, such as the Sacramento market, where we've got what's called a high balance loan. That's a separate bucket. That bucket is between the 510 and in the high balance markets up to that high balance limit. So in Sacramento, the 5-county Sacramento MSA, it's $569,250. In the Bay Area, it's $765,600. So a significant opportunity for high balance loans, but anything above that is considered a jumbo loan. I've talked about this many, many times over the last few weeks, so I'm not going to dive in deep. What I'll tell you is that there is a serious amount of confusion out there, both with consumers and with realtors, about what the heck does a jumbo landscape look like. So I'm going to try and clarify it for you. The banks are loaning their own money, and they're currently afraid to loan their own money on jumbo mortgages in the housing market right now. There is no what is called a secondary market. Nobody is buying pools of jumbo loans. If you find a bank that will fund a jumbo loan, they're loaning it out of their own deposit base. And they are making their own decision on what constitutes credit risk. I used to say jumbo loans are the wild, wild west. Well, if somebody can help me figure out what's wilder than the wild, wild west, that's where we are right now. The rules vary so much from one institution to the other. And as I explained to one client that I talked to yesterday, she wanted to buy a $700,000 home in the Sacramento area, and she only has enough money for 5% down. And I said, look, your only choice is to pick up the phone and call as many banks as you can, because I don't know if there are no brokers that I know of. There are no correspondent lenders like Summit Funding that have access to that small of a down payment jumbo loan. And in a lot of cases, we don't have access to any jumbo loans. But I told you need to be careful, because you've got to ask the right questions about what their criteria are, because they have layers and layers of rules, the biggest ones being reserves. They're going to say, sure, you can put 5% down, but you got to have 10% of the purchase price in savings. Well, wait a second. Why would I only put 5% down if I had 10% of the savings? Really what you're telling me is I have to have 15%? Because I got to have 5% for down plus 10% for savings? I saw one bank that required that. So they're saying they'll do it, but are they really doing it? Like the guy who needs 5% down on a $700,000 home, he's asking for it because he doesn't have 15% to put down. That's what we're dealing with. So what I am telling people is there's a great alternative to jumbo loans, and it's a combo first and second mortgage. What's interesting, and this is more of a statement about just human dynamic, how we think as humans, and I'm speaking of myself and how I think. So I had previously sold more of these combo first and second mortgages Even when I had 11 different banks that I could do jumbo loans with, this was the best product. It has huge benefits that I'll cover in just a second, but the human mind plays tricks on you. Because when you have a choice, when I say, hey, I can give you a jumbo loan or I can give you this alternative loan, and most people choose the alternative loan because it is overall a smarter option. But when you lose the choice, it's a lot harder to sell the alternative idea when you can't offer them, oh, by the way, I can do this, but I think this is better, and it's a mental thing. And so I've had to kind of reframe my thinking. Instead of saying, hey, I got bad news, I can't do a jumbo loan, but I got this other way to do it, I should start with, and I am starting with, hey, I've got great news. Of all the jumbo programs that I used to help people get jumbo loans, all but one of them are gone. And the good news is the one that's still here is the one that I've used the most. That reframes it totally different in the eyes of the consumer. And I need you guys to make sure that you're taking the information I'm giving you and reframing it. I'm giving you the raw data about all of this stuff. I don't want you walking out to your consumer saying, oh my God, the mortgage market's falling apart. Okay, that's the wrong message. Reframe it the right way. Here's how the jumbo or the combo loan works. It's a conventional first mortgage. We're doing the first mortgage up to the 510 or the 569 or the 765. And then we're layering on a second mortgage. That second mortgage will go up to 90% of the value of the home. But there are no reserve requirements. You have to put 10% down, but we don't require any reserves on this program. The rules are very standardized because the second mortgage program that we use follows Fannie Mae and Freddie Mac's guidelines. With a couple exceptions, they don't go up to 50% debt to income ratio. They want us to be no more than 43% debt to income ratio, but that's not that big of a deal. But overall, we follow normal Fannie Mae and Freddie Mac guidelines, and you can borrow up to 90% of the value of a home. You could buy $1 million home and put only $100,000 down. And this is a great tool. Now, the second mortgage is a variable rate loan. That is the negative about it. The interest rates are significantly better than jumbo. The qualifications are significantly better than jumbo. The second mortgage is tied to prime, and the prime rate is expected to stay low for a long time. When we look back historically, the prime rate dropped significantly in 2008. It didn't start moving up until 2011 or 12. And so we've got 3 or 4 years for this to play out. And during that time, we should see some good appreciation. We should also see the conforming limits go up so that hopefully we can get that loan refinanced. But it's not a crazy adjustable rate mortgage. It's not one that's going to skyrocket. And so you don't have to worry about what happened in 2005, 6, and 7 where people had adjustable rate mortgages. The majority of your mortgage is a fixed rate first mortgage. It's only that second mortgage that's adjustable. And even if the interest rate doubled, I've run numbers with clients, and even in the worst case scenario, it's adding $300 to their monthly payment. It's not that big of a deal. The theory sounds scary, but when we put pen to paper, it's a great alternative. So when people say, including me, hey, the jumbo market's dead, there's no way to do it, it's a lie. We just have to think a little bit outside the box and present it appropriately to our buyers, but it's an amazing option to do 10% down on a jumbo loan. All right, guys, I'm about done. I know that Jeff had popped in and he had said there really isn't anything new in the title and escrow world. Jeff, do you have anything to add? Do you want to even just say hi?
Hi. No, I mean, the only thing is just payoffs are taking a little bit longer because of the lenders being inundated. So what normally would have taken 3 to 5 days could be 5 to 7. If it took 5 to 7, it could be 7 to 14. Other than that, phishing attempts are up 667% because of COVID. So be diligent in protecting your clients from wire fraud attempts. We do have a secure 2-factor authentication portal for buyers, sellers, and borrowers that we utilize after opening escrow. Your client will get an email on how to go through the process. I could provide the link to a video explaining how it works in the chat. Other than that, no new update on remote online notarization. We did check with San Joaquin and Stanislaus County recorders if they would accept it, if it was presented. They both said, well, we'd have to see it. So I don't know who's going to be the test dummy on that one, you know. let's go remote online notarization. They look at us like, no, it's not good enough. So that's about it. I'm going to put those links in the chat. And they did modify, San Joaquin Department of Health did modify the essential business definition for real estate, and I can provide a link to the actual order in the chat too. That's about it. Thanks, John. Appreciate it.
My pleasure, Jeff. Thanks for piping in. I actually was on a webinar this morning that was talking about some of this, e-solutions for closings. And a couple things I pulled out of that, and I might have gotten my data wrong, but I don't think so. They said 45 states have some sort of remote online notarization solution. And so if I heard that correctly, that means that California is part of the 10% that doesn't. So lucky us, guys. Welcome to California. Almost everybody else, 90% of the United States can do it, but we can't. They also, there's a new word, and I don't know, or new acronym, because we all need new acronyms, right? So we've been learning RON, Remote Online Notarization. I heard a new acronym, RIN. Yeah, Jeff, tell me what RIN is.
RIN is where basically the signing is done via video. The wet signatures are done via video by the borrower. And then the borrower sends the documents to the notary and they actually stamp it. So it's kind of like a hybrid between a regular type of signing and remote online notarization where it's electronically notarized.
And this, so a RON is digital signatures and a RIN is ink, pen, and paper signatures. Is that the basic way to say it?
But the meeting is actually done on video.
On a RIN.
Instead of in person, right? Yeah.
Okay. All right. Y'all got that? There'll be a test at the end about RIN versus RON versus RON. Okay. What's RON? I have no clue. All right. It just rhymed. All right. Perfect. Guys, we're about wrapped up. I want to remind you, first and foremost, you saw hopefully in the text message I sent out this morning, I need your help. I am absolutely looking to grow the reach of the information that I'm presenting here on a weekly basis. And I want to count on each and every one of you to help me do that. So if you know someone in the real estate world, raise your hand if you know someone in the real estate world that's not on this call. Yeah? Yeah? Okay, I need your help. My 8-year-old daughter just raised her hand. So all right, Cassidy, I need your help. So that's the fun of working from home, right? Here, y'all want to meet my 8-year-old? Come here, kiddo. Say hi, everybody. Hi. All right, now go away. All right, so I need your help in forwarding this information to them and encouraging them to join. I hope you find it valuable. You keep coming back every single week, and it isn't just to see my daughter. So I really would appreciate if you guys would help spread the word on this. RSVP with John is the best way to see all of my events, including this event as well as my consumer events. So last Thursday, I did an event for homeowners talking about issues they need to be aware of in the mortgage market. I thought it went really, really well. I got great feedback. You can find that on my YouTube page. This week, I'm doing understanding credit scores. There is a huge amount of misinformation out there about credit scores and how it works. People take the wrong steps in trying to improve their credit. And I'm going to help debunk a lot of those myths and help people understand what they need to do to make sure they have good credit, how to maintain good credit, what the differences are in credit scores. I'm going to cover a lot of great information. So you can go to the same page, RSVP with John, to register, forward that to your clients so that they can register. All of my events are realtor neutral. So I'm not going to be pitching a realtor. I'm not going to have a realtor talking. I will be talking about the fact that you should use your realtor, because Barbara Zaragoza beat me up on my event last Thursday when somebody had asked me, as a matter of fact, it was one of Beth Logue's clients, and the client had said, hey, John, how do I find out the value of my home? And I went on Zillow and I started to explain to him how to really look at Zillow appropriately. And Barbara immediately chatted to me saying, John, the answer is they need to call their realtor. So Beth, I'm going to have them call you. So yes, it was absolutely, I was trying to give accurate information, but really I'm 100% pro realtor. Don't worry about that part. Next week, I'm doing the 6 Steps to Financial Freedom workshop. I get people into the biggest amount of debt they've ever been in their lives, and I want to help them get out of that debt. And so I help people with kind of strategies of how to become financially free and the order in which you should focus on paying down debt, etc. May 14th, we'll talk about how to buy a home when you already own one, because so many people don't understand the process of contingent sales. They don't understand the process about, hey, do I find a buyer first for my home, or do I find a new home first? and how does that work, and what do I do? Can I own 2 houses at once? If I keep my current house, can I convert it to a rental? Those are all questions I'm going to answer. You can send that to your entire database, because you know the people who currently own a home that go to that webinar are thinking about buying. It's a great opportunity for you to segment your database, have them reach out to you to register, and then you can register them. But that way you know which of your clients are thinking about buying a home coming up if they respond to a webinar like that. There are more webinars that'll be on the webpage. I really appreciate you guys' time. I really appreciate you guys coming every single week, and I really appreciate you helping me to share these events. If nobody else has any other questions, then have an absolutely amazing day, gang, and we will see you next week. Bye.
Thanks, John.
You're welcome.